Treasury issues gold certificates to the Fed. The Fed prints $6 trillion out of thin air, devalues the dollar tremendously, gives it to the Treasury general account, who can start to work down debt. The Fed does not have access to that gold. It's collateral, but they only have claim on the cash value of that gold. Now you just massively devalued the dollar. That is what revaluing gold is. It goes back to my thesis. They're going to devalue the hell out of the dollar in order to do these things, and they're going to inflate. The dollar's down 10% this year. So is gold up 10% or 50%? Is it up because gold is up, or is it up because the dollar keeps on falling?
Right.
AndySchectman, CEO of Miles Franklin, warns that the U.S. is sitting on a debt time bomb. Roughly $28 trillion in treasuries will mature over the next 3 years, while annual tax revenues amount to only about $15 trillion. Add in persistent trade and budget deficits, and the math doesn't work. According to Schectman, the prevailing sentiment in Washington is that the U.S. may no longer want to bear the burden of serving as the world's reserve currency. Schectman points to analysts like James Rickards and Mike Maloney, who argue that the Treasury has one dramatic option: reprice gold. If gold were suddenly valued at $10,000 to $24,000 per ounce, the Treasury could instantly book trillions of dollars in new value on its balance sheet. It could then issue certificates to the Federal Reserve, inject liquidity into the system. Schectman calls this a soft default on the dollar. The currency would be sharply devalued, but borrowing costs would collapse, U.S. exports would gain competitiveness, and the economy would be given a new lease on life. Central banks appear to be preparing for precisely this kind of shift. After decades of selling, they have become record buyers of gold. Countries from Germany to Turkey have repatriated bullion from vaults in New York and London. And under Basel III banking rules, gold was upgraded to a Tier 1 asset, placing it on the same level as cash and sovereign bonds. Schectman says the message is clear. The most prominent players in the system are moving away from treasuries and toward gold. When the monetary reset comes, the asset without counterparty risk, the one that cannot default, will be the last one standing. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
There's a massive disconnection between the equity market and Main Street. Ultimately, this is all very positive for gold. Very, very positive for gold, because, you're talking about an environment where gold doesn't just go up because of the currency debasement. It goes up because almost everything else looks worse. That's just the truth of it. And if you look at the fact that my whole career, which will be 36 years this February, less than 1% of COMEX contracts ever stood for delivery. Now, all of the gold that's coming into COMEX, what we know of, over 100 billion since the beginning of the year, and I would argue that a whole bunch more is coming in not through COMEX. The biggest money in the world is importing gold in the United States at a level that no one has ever seen before. But more crazy than that, and I think this is a bigger indictment, and actually you got to wonder where the hell is it going and who's doing it, who's the big buyer. I think it's the Treasury, myself, or the Fed. But with all this gold coming in, less than 1% of contracts on COMEX, once they would post, like, okay, they expire August 1st, you can take cash, you can roll it forward, or you can stand for delivery. Less than 1% ever did. Just in the first 3 days of the August contract, we saw over 2,160,000 ounces of gold stand for delivery, which represented 100% of the 2,160 contracts that stood for delivery, that posted. 100% of them stood for delivery. And crazier than that, almost all of it is leaving COMEX. About 90+% of it is actually being offloaded. Well, Vice President Vance has said it, wrote about it on White House letterhead, that we're at a point where being the reserve currency isn't such a good thing anymore because of Triffin's dilemma. And, so how do you bring back manufacturing? We owe $28 trillion in 3 years. In maturing treasuries, we've taken $15 trillion in tax revenue. That doesn't even count the trades imbalance or the budget deficit of $3 trillion a year. We're a third of the way there in 3 years. I think they're going to default on the dollar. I don't think they want to be the world reserve currency anymore. In order to bring back manufacturing, what do I mean by that? Judy Shelton, what did she say? They're going to back on July 4th next year. She told me and you this. They're going to issue treasuries pegged to gold, right? Next year. Well, why would they do that? They would do that to have zero borrowing costs on the back end of the treasury market. Zero, redeemable in gold. If you go out to 50-year, like she said would start, there'd be a little coupon on it, plus the gold redeemability. You go all the way down maybe to 10, no coupon, zero interest, redeemable in gold. Well, what does that do? That allows you to have zero borrowing costs to bring back your manufacturing. Now, how do you make your manufacturing competitive? You devalue the dollar. How do you do that? You revalue gold. And if James Rickards is right, or Mike Maloney, he says 10,000, Rickards says 24,000. The president would tell the Treasury revalue gold right now. The Treasury tells the Federal Reserve with no congressional approval, do it. It's held in the gold revaluation account. They put it at 24,000 an ounce. Like Rickards says, this is him, not me. That gives the Treasury Department $6 trillion free and clear. Treasury issues gold certificates to the Fed. The Fed prints $6 trillion out of thin air, devalues the dollar tremendously, gives it to the Treasury General account, who can start to work down debt. The Fed does not have access to that gold. It's collateral, but they only have claim on the cash value of that gold. Now you just massively devalued the dollar. That is what revaluing gold is. That's what Roosevelt did. That is what it is. So now you devalue the dollar and you have zero coupon on the back end of the bond market, so you can bring back your manufacturing inexpensively and sell your goods inexpensively. Well, how do you run the government? Oh, I got a good idea. Let's call it the Genius Act. And we'll have every corporation and bank on the planet start issuing U.S. Treasury-backed, synthetically backed stable coins.
Right.
And that's going to make $2 trillion a year. Yes, and so this is how you give demand to the front end of the market. The back end of the market's pegged to gold. And if I'm right, and if Judy is right, you'll see gold higher than you can imagine. Now, the only hiccup in that is a soft default. Richard Russell said for years they can inflate or they can die, they being the Fed. Well, this is a soft default on the dollar in order to reshore manufacturing, in order to at some point grow our way out of this problem with 60% of the country having no college education. We must have that stuff, especially the critical stuff. This would give us the ability to do it. Now, the only thing that I could see in the middle of that would be universal basic income for a few years, because if you don't have assets, you're dead in the water. If you hold your money in dollars, you're dead. It helps them too, because who's been buying all the gold? Oh, that's right. The central banks of the world have been eating gold at a level no one has ever seen before. These people understand the game. They talk to each other. Just like 9 years of net central bank selling, you start to see the Bundesbank say, give us back our gold. And then you saw the next year, 2018, Dutch, Austrian, Hungary, Turkey, Poland, all these banks did the same thing and bought more gold than they did combined in the 60 years previously. 2019, they doubled that number. And then the BIS says, oh, by the way, Basel III Accord, gold is now tier 1. Oh, really? So you didn't know about that. And you didn't start bringing all your gold home from the New York Fed and the Bank of England and start buying it. They know where we're going. And I think they're all clued in by the BIS and the IMF, and they all speak. If I was ahead of a massive deal and you're my best friend, you don't think I'm going to wink, wink, nod, nod, Adam, you might want to buy gold. That's just what a rumor I heard. They do that. And that's why these moves are always very much in front of everybody else. But these moves are so big and so significant and gaining zero media attention that in and of itself is wholly significant. It all hasn't, but a good portion of it has. I don't know, between the New York Fed and the Bank of England, between 30 and 40 countries have brought their gold back. And you hear Germany saying we want the rest of our gold back, and that you'll see that following suit. A lot of the countries have brought all their gold back, but not everyone is, I guess you could say, adversarial or quasi-adversarial, or maybe see things the same way as some of these countries who have repatriated their gold. But I think you'll see over time, if it will leave, they'll want it back. Yeah. You look at the Bank of England saying to Venezuela, no, you can't have your gold back. I think leaving your gold in the Bank of England or the New York Fed is as stupid as a mud wall. Right. The Fed can't control the back end of the bond market unless they start to monetize it, which is the pathway to hyperinflation and Weimar Republic. So I think they'd be out of their mind to not move it to gold. Let's just look at 3 numbers. 25 years. Last 25 years, gold has doubled the performance of the 10-year Treasury. How about last year? Gold was up 40%, the 10-year Treasury up 4.5%. How about this year? Halfway through the year, that 10-year Treasury is up just over 2%. The dollar's down 10. Oh, you're negative 8%. Gold's up almost 40. That's a 50% swing. So I think a lot of people are doing that. It's starting up at levels in central bank levels where they're selling Treasuries and buying things like gold, which not only has outperformed it, but like we're seeing with the repatriation and the removal from the exchanges, has no counterparty liability.
AndySchectman points to data from the London Bullion Market Association that shows a troubling picture across the precious metals market. Silver inventories are dropping at a steep angle, platinum is in even worse shape, and gold looks a little stronger, but even those numbers raise doubts. Schectman asks the obvious question: are the published figures even real? If they are, then platinum and silver supplies are already dangerously thin. At the same time, COMEX tells a different but related story. According to Schectman, 8 central Western banks now hold the most prominent short position in silver in the entire history of the exchange. They also carry massive shorts in platinum and gold. On paper, these positions appear to offer control, but the problem is that the amount of actual physical metal in the vaults is only a fraction of what is being traded through contracts. Since 2020, Schectman says, countries in the global south may have identified the weakness. By exploiting paper suppression, they've been steadily draining the physical supply, pulling metal from exchanges, miners, and refiners without significantly affecting the price. The real danger, Schectman argues, is what happens if the drain isn't slow anymore. Rogue players, whether a hedge fund, an ultra-wealthy investor, or even a nation less concerned with financial stability, could decide to scoop up massive quantities at once. Such a move could potentially lock up the entire system overnight. In that scenario, the winners would be those already holding physical silver in size, while everyone else would be left scrambling to secure supplies at far higher prices. Let's get back to the interview.
Well, they post numbers. You could pull it up right now. You could say graph of LBMA silver chart. You'll see it's fallen at a 45-degree angle. Their gold isn't as bad, but you have to ask yourself, are these numbers really even accurate? Are they being honest about it? I don't know.
Right.
But if you take it at face value, their platinum and their silver are in big trouble. Their gold isn't quite as bad, but it's interesting too. If you look at the shorting on COMEX, what's his name? Nick Laird. Nick Laird does a wonderful site, does charting, and he shows a chart of all of the commodities and the short positions on COMEX. The largest short position by far, by 8 Western banks in any commodity ever traded in the history of the COMEX, is in silver. Number 2 is platinum. Number 3 is gold. So platinum and silver are literally being drained out of those exchanges, and they have fraction of the amount of underlying metal as the amount of spot deliverable contracts that are being traded. I have been arguing since 2020 that these countries in the global south have, for the last several years, were sophisticated, coordinated, motivated, and wealthy, and were using the suppression of the Western paper market, in fact, aiding and abetting its suppression, so they could go all around the world and pick the pockets.
Right.
Little by little, from all of the exchanges and venues like the miners directly, that doesn't affect the price. Well, you're getting to that point where there's not really a whole lot left in London to pick. The point of it is we don't know who's bringing all this gold and silver in, but if you saw this stuff coming and you were worried about tariffs and you were worried, you'd bring the metal back. So I think it's deeper than that. But I think if you're going to do a new system in the West that is tied to gold as an anchor, you can't have your big banks massively short or the whole system blows up before it even gets started. So maybe that's part of it. They're bringing it back to reshort, to cover their shorts, and it ain't ever leaving again. It's never going to go back to London, I think, if President Trump has anything to say with it, would be my guess. Now, I really do believe this. I really do believe that someone got in his ear and said, we must do this because the rest of the world is draining what is available. When you have China, the largest producer of gold in the world and the second largest producer of silver in the world, flying all around Latin America, buying silver before it's even called silver out of the ground from Mexico and Peru, right, and the same thing with gold, and then sending it back to China to refine it. Well, why would the largest producer and the second largest producer of silver in the world need to do this? And it just goes to show that they see things they're 3, 4, 5 steps ahead.
Scarce.
And ask yourself, who just took possession of $7 billion worth of silver? We don't know about it. So maybe, just maybe, and if you are one of those guys, the last thing that you're going to do is talk about it until you have it in your warehouse, like David Bateman did. Now he's talking about it. So
build your book, then
maybe
talk your book.
right. And so maybe that is happening right now. And that's a valid point. And a lot of people say, well, if China's so interested, why don't they just buy it all? Because you cut off your nose to spite your face, because markets would seize up like that and everything would just stop. Slowly, the death by 1,000 paper cuts. Use their stupidity against them, they say to us. It's the art of war. And that's what they're doing. And David Bateman figured it out before others. And now he's talking about, 50% of the employees at NVIDIA are now worth $50 million or more, something like that. You could see, get a whole bunch of people to spend $20 million on silver. And in 10 minutes, the entire amount of silver in this country for retail is gone. Silver is about 800 million ounces that comes to market. But of that 800 million ounces, if we can pull out recycling, which is a little bit, only about 200 of the 800 million comes from companies that mine silver, like First Majestic, as an example. Because silver is found in nature, like your skin is epidermis. Silver is found in a level called epithermal, right near the surface. Big deposits were found forever ago. So 70 to 80% of all the silver that is brought to market comes from companies mining completely different. Yes, tin or copper or gold. Here's some silver. So it's depleting in nature. And for 5,000 years, it was 16 to 1 in the ground, 16 silver, 1 gold. Keith Neumeyer has been for 3 years saying it was 8 to 1. Now it's 7 to 1. It's disappearing. 7 ounces of silver for every 1 ounce of gold. So about 800 million ounces of silver, and I think about 250 in gold, I think. Don't quote me on gold, but silver I'm right on. If it weren't for the central bank and by proxy commercial bank suppression of gold and silver, it would be massively higher. And it's funny, people on one hand say that its performance really isn't that great in comparison to things like risk on trade and NVIDIA and Apple, where you're getting 3 and 4 digit increase. Gold is slow and steady, and in an environment where the value of the currency is inherently meant to die, like all fiat currencies, it's going to continue to go. And as Rick Rule pointed out, and I've been saying it, citing examples, he said it Rick is just a master of the English language, and is very simplistic too. He says, people think things are getting expensive, but price anything you can think of, from food to real estate, and in gold, and it's cheap. So it's not that gold has made its run. It's that the dollar is continuing to lose its value. And as that continues to happen, the run that people perceive as gold going higher will only be accentuated in the face of a falling dollar. And the dollar will fall. Stephen Mirren, who just got into the vacated spot, he's the head of the author of the Mar-a-Lago Accord. He wants a devalued dollar. Goes back to my thesis. They're going to devalue the hell out of the dollar in order to do these things, and they're going to inflate. The dollar's down 10% this year. So is gold up 10% or 50%? Is it up because gold is up, or is it up because the dollar keeps on falling, magnifying?
It's staying the same, but dollar value just going down. Yeah.
What emerges from these warnings is not just a story about debt or bullion, but about the foundation of trust in money itself. With official balances under strain, markets loaded with paper claims, and physical stockpiles thinning, cracks are widening in places that most investors rarely examine. The idea of a currency reset tied to gold may sound extreme, but when conventional fixes no longer add up, drastic measures become less unthinkable. The shift seems less about whether it will happen and more about how quickly confidence in the current structure erodes. Could the next real shock to the financial order come not from markets we watch daily, but from the sudden disappearance of confidence in the very reserves those markets are built on? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.